For the past few days, most investors have been glued to their screens watching silver bounce around the $90 level like a nervous boxer on the ropes. Every dip triggered panic, every bounce sparked hope. Commentators argued over charts, patterns, and whether the bull market had finally run out of steam. It all felt dramatic, urgent, and exhausting. But while everyone was staring at the flashing numbers, something far more important happened quietly in the background. And almost nobody noticed. The United States government blinked. Not in a press conference, not in a headline, but inside a government agency that rarely makes noise at all. The United States Mint. The very institution responsible for producing America's official coinage quietly updated its internal pricing. No fanfare, no announcement, just a number change in the system. And that number change speaks louder than any Fed speech ever could. We have confirmed that the Mint has repriced the proof American Silver Eagle to 173 and the uncirculated bullion version to 169. Let that sink in. Your screen says silver is $90. The US government says it is worth 173. That is not a normal premium. That is not a little markup for packaging and shipping. That is nearly a 100% gap between the paper price and the government does own physical replacement cost. This is not a price increase. It is a confession. When the entity that prints the currency turns around and effectively says, we can't replace silver at anything close to the market price, that is not bullish marketing. That is an admission that the official price mechanism is broken. Skeptics will say, but the Mint isn't even selling coins right now. Sales are suspended. This price doesn't matter. It matters more than anything else on the board. Think about it. Why would a government agency that is currently closed for sales go into its system and almost double its price tag? Why not wait until reopening day? Why bother updating anything at all? Because they know that when they reopen, they cannot sell silver anywhere near $90. If they did, they would be cleaned out in hours. They would be dumping a strategic asset at a fire sale price. This is the Mint front-running reality. They are positioning for the price they believe will clear the physical market when real metal is actually available. They are telling you, without saying it out loud, that $90 is a fantasy number created by derivatives, not a real-world replacement cost. What this creates is a two-tiered market. Tier 1 is the paper world. Wall Street trades digital contracts back and forth and pretends silver is $90 because that is what the futures market prints. Tier 2 is the physical world. Mints, refiners, dealers, and industrial users operate in a completely different universe where actual metal must be sourced, shipped, insured, and replaced. In that world, the number is not $90, it is closer to $170. When the spread between paper and physical is $80, the market is no longer discovering price. It is discovering insolvency. And this changes investor psychology in a profound way. If you own physical silver and you see the US government pricing it at $173, are you going to rush out and sell it for $90? Of course not. You're going to sit on it. You're going to wait. You're going to realize that the banking system is offering you half of what your asset is actually worth. This is poison for short sellers. The banks need metal holders to sell so they can close positions and source supply. The Mint just told every silver owner in the country to do the opposite. They accidentally created the ultimate diamond hands narrative, and they did it with a spreadsheet instead of a meme. The timing makes this even more interesting. This repricing happened late on a Friday afternoon, right after a major attempt to smash the paper price failed. The banks tried to drive silver down to $86. They couldn't hold it there. The market closed the week above $90, marking the first weekly close above $90 in history. And immediately after that failure, the Mint reprices silver at $173. That is not random. That is institutional positioning. What we are watching is a war between two forces. And on one side is the deflationary pressure of the paper market. Lower prices protect the dollar and protect leveraged financial structures. On the other side is the inflationary reality of the physical world. Mines, refiners, and mints cannot operate on fantasy numbers. At some point, real costs dominate. By pricing silver at $173, the Mint has chosen a side. They have aligned themselves with the physical market, not the paper market. They are effectively admitting that the purchasing power of the dollar has deteriorated to the point where a 1-ounce silver coin now requires nearly 200 units of currency. This is what a currency crisis looks like in real time. It is not a dramatic overnight collapse to zero. It is a series of quiet repricings where real assets suddenly cost far more money than they did yesterday. The screen says $90. The Mint says $173. Which one reflects reality? The price of a digital contract that may be settled in cash, or the price of a physical coin you can actually hold in your hand? The answer is obvious. The paper price is a coupon. The physical price is the asset. And the coupon is starting to look like it is close to expiration. But if the Mint's repricing was the signal, what happened in the vaults was the action. While the mint was adjusting numbers on a website, something far more concrete was happening deep inside the bullion storage system. We analyzed the daily warehouse reports from the CME group for Friday, January 16th. These reports are usually dull, small inflows, small outflows, a few thousand ounces here and there, the financial equivalent of watching grass grow, not this time. On that single day, more than 4.2 million ounces of silver were physically withdrawn from COMEX vaults in one day. To put that in perspective, 4.2 million ounces is about 130 metric tons of silver. This is not someone stacking a few tubes of coins in their basement. This is not a jeweler restocking inventory. This is logistics. This is armored trucks. This is cargo planes. This is a strategic relocation of metal. And it was not concentrated in one place. The data shows that 1.4 million ounces were pulled from the Asahi vault. About 1.2 million ounces were pulled from CNT. Another 1.2 million ounces came out of JP Morgan's vault. Nearly 800,000 ounces were withdrawn from Manfra, Tordella, and Brooks. Every major custodian was hit. This was not random, it was coordinated. And here is the part that should make every serious market participant sit up straight. This massive physical withdrawal happened on the exact same day the paper price was smashed to $86. You are supposed to believe that is a coincidence. It isn't. If you are withdrawing over 4 million ounces of silver, every dollar matters. A $6 drop in price saves roughly $24 million on that transaction. Smashing the price first and then taking delivery is not market chaos. It is strategy. They didn't crash the price to make money on the trade. They crashed it to make money on the metal. They needed cover. But the most important number is not the total withdrawal. It is what happened to registered silver. In the COMEX system, registered silver is the metal that is actually available for delivery against futures contracts. It is the supply with a for sale sign on it. On Friday, registered silver collapsed by more than 2.5 million ounces. It now sits around 120 million ounces. That is the buffer. That is the safety margin. And it is shrinking. This is how stress shows up in a physical market. Not with fireworks, but with inventory draining away quietly while the price mechanism struggles to reflect reality. The mint told us the value. The vaults told us the scarcity. Together, they tell us something much bigger than daily price swings. The game is changing. Something subtle but extremely important is happening beneath the surface of the silver market, and most people are missing it because they are staring at price charts instead of inventory data. The real story is not what silver is trading at. The real story is who is quietly pulling it off the market. When registered silver collapses this quickly, it sends a very specific message. Registered metal is not just sitting in a vault. It is metal that has a for sale sign on it. It is available for delivery against futures contracts. When large amounts of that category suddenly vanish, it means the owners are changing their minds. They are removing the sign. They are moving silver from the public marketplace into private hands. That is not what you do when you believe prices are about to fall. That is what you do when you believe something big is coming. So why would banks and trading houses pull inventory at the exact moment silver is printing record highs? Why not sell into strength like every textbook recommends? Because they know what is being discussed in Washington. They know about the Trump proclamation. They know about the Section 232 review. They know that if the U.S. government declares silver a critical mineral, the entire market structure changes overnight. Price floors, export restrictions, strategic stockpiles, all of that suddenly comes into play. If that happens, you do not want your metal sitting in a highly visible public vault in New York. You want it somewhere private, preferably somewhere offshore. We strongly suspect a meaningful portion of the 4 million ounces that just left COMEX is not going into domestic storage at all. It is likely headed toward London or Shanghai. And that matters because London is already on fumes. The London Bullion Market Association is reportedly running dangerously low on available float. The price gap between Shanghai and London is draining metal out of the UK just as fast as New York is being drained. The banks are stuck playing global whack-a-mole. They pull silver from COMEX to plug holes in London. They pull from London to satisfy Asia. It is a shell game where every shell is empty. They are robbing Peter to pay Paul, except Paul is already broke. This is the final phase of a physical squeeze. When you see 4 million ounces leave in a single day, you're not watching healthy market activity. You're watching liquidity evaporate. You're watching the exit doors being slammed shut from the inside. And this circles us right back to that $173 US mint price. The mint is not stupid. They see the same inventory reports. They know the vaults are being drained. They know that if they tried to source several million ounces tomorrow to restart large-scale coin production, they would struggle to find the metal. It is already spoken for, so now we have a surreal situation. The paper market says silver is $90, while the physical market is quietly disappearing. This is a guaranteed failure point. A futures exchange cannot function if the underlying commodity vanishes. If COMEX continues to bleed at anything close to this pace, registered inventory could be exhausted in roughly 30 trading days. 30 days. That takes us straight into the March delivery month. March is traditionally one of the largest delivery periods in the silver market. And the open interest data suggests something unusual is happening. Traders are not rolling forward, they are rolling backward. They want metal now. But if the banks drain the vaults in January and February to ship silver overseas, what exactly will be left in March? At that point, the exchange faces a force majeure event. That is the polite legal phrase for, we can't deliver what we promised. It is the moment when contract holders are told, sorry, we don't have the silver, here's the cash equivalent. That might work for speculators. It does not work for industrial users. Manufacturers cannot build solar panels with checks. They need metal, which is why the Friday night withdrawal was not just a transaction. It was an insider signal. The biggest players are securing physical supply while they still can. They are taking their chips off the table. And for retail investors, this is the loudest warning bell imaginable. The banks are taking delivery. The government is suspending sales. The vaults are draining. If the smartest and best connected institutions in the world are grabbing physical silver and heading for the exits, it raises an uncomfortable question. Why are so many people still holding paper claims? Because that brings us to the third and most unpredictable force in this market, the retail public. For years, silver was a niche trade, a quiet corner of the financial world occupied by contrarians, hard money types, and people who own more canned food than furniture. Then something changed. Over the last 6 months, the psychology of the average investor has shifted dramatically. According to new data from the COMEX letter, one of the most respected institutional research firms, retail investors have been net buyers of the largest silver ETF, SLV, for 169 consecutive days. 169 days. That is nearly 6 straight months of relentless accumulation. It is the longest buying streak ever recorded. In just the last 30 days, silver ETFs have attracted more than $920 million in new capital. Buying pressure is running at more than double the 3-month average. This has officially surpassed the intensity of the 2021 silver squeeze. Back then, it was a Reddit-driven flash mob. Loud, chaotic, and short-lived. This is different. This is not a flash mob. This is a migration. Capital is quietly leaving stocks, leaving bonds, and seeking refuge in hard assets. The public is voting with its money, and the vote is not subtle. But here is the tragedy. Most of this tidal wave of capital is flowing into the wrong vehicle. The majority of retail investors are buying paper ETFs like SLV, believing they are buying silver itself. They think they are removing metal from the system. They are not. When you buy SLV, you are buying a trust unit. You are buying a financial claim on silver that is held in a vault controlled by JP Morgan. Yes, that JP Morgan. The same JP Morgan whose vault just saw massive withdrawals. This creates a conflict of interest so large it deserves its own warning label. The custodian of the silver is also one of the largest short sellers of the silver. That is not a coincidence. That is a structural flaw. Which brings us to the real pressure point in this market, the bank's derivatives exposure. Multiple reports suggest that major institutions, particularly Bank of America and Citigroup, are sitting on enormous precious metals short positions. Some analysts estimate their combined gross short exposure could be as high as 4.4 billion ounces. Read that again. 4.4 billion ounces. Global mine production is roughly 800 million ounces per year. These banks have sold paper silver equal to more than 5 years of global output. They have sold silver that does not exist. They have sold silver that has not even been discovered yet. That is the textbook definition of a naked short. And now they are trapped. On one side, the retail public is pouring billions into the market, pushing prices higher. On the other side, institutional whales are removing physical metal, stripping away the collateral that underpins the paper system. They are caught in a tightening vice. If silver rises to $100, the losses on a multi-billion ounce short position become existential. We're not talking about bad quarters. We're talking about balance sheet destruction. Losses of that magnitude would dwarf 2008 and would almost certainly require central bank intervention. This explains the violence of the recent price action. This explains the engineered smash to $86. They are not trading for profit anymore. They are fighting for survival. And history is not kind to leveraged players when physical reality finally overrides financial engineering. If you want to understand what the public is really thinking, don't listen to what they say. Watch what they do with their money. And right now, their actions are screaming. 169 straight days of buying tells us something crucial. People are no longer selling the dips. They are buying them. Every time the banks try to smash the price, ETF inflows don't dry up. They accelerate. What is meant to be a scare tactic has turned into a discount coupon. The banks are trying to push people out of the market. Instead, they are rolling out the red carpet and saying, "Welcome, silver is on sale today." This is the classic unstoppable force meeting the immovable object. The unstoppable force is the inflation-aware public. The immovable object is an over-leveraged banking system sitting on a mountain of synthetic silver. One of them must break. And based on the vault data, it is not the public. What is giving way is the physical inventory. The ETF structure has acted as a shock absorber. It soaks up retail demand and keeps it away from the real metal for a while. Authorized participants can use leasing, swaps, and accounting gymnastics to satisfy ETF rules without immediately delivering bars. On paper, everything looks fine, but this is not magic. It is just delay. Eventually, the mismatch becomes too large to hide. If SLV claims to hold 500 million ounces, while physical inventories are being shipped to Asia, the system reaches a breaking point. At some level, paper promises overwhelm physical atoms. That is the danger zone. For the individual investor, this data carries an uncomfortable message. If you are part of that 169-day buying streak and you are holding SLV, you are sitting on a receipt for a car that may already be halfway to another continent. When the pressure finally breaks the banks, ETFs will almost certainly be settled in cash. They will hand you dollars and say, "Here's your profit." But you do not want profit in dollars. You want silver. The retail crowd has the right instinct and the wrong vehicle. They are buying the map instead of the territory. The sentiment shift is real. People know the dollar is weakening. They know inflation statistics are polite fiction. They are voting with their wallets. Unfortunately, they are voting in a rigged ballot box. And while the public is buying paper claims, the smart money is doing the opposite. The Friday night vault drain was not random. It was professionals taking physical supply before ETF holders realize how tight the market has become. Now look at the setup for the week ahead. We have a market where the screen says $90. The US Mint says $173. Shanghai trades at a massive premium. And the banks are short billions of ounces they do not possess. This is not a stable system. This is a powder keg. Retail buying is the fuse. The vault drain is the spark. And the explosion will be a repricing large enough to rebalance a completely distorted market. That level is not $90. It is not even $100. It must be high enough to force metal back onto the market and break the short positions. Otherwise, nothing clears. Now step back and look at the full picture we have built. We have the sovereign leak, where the US Mint quietly admitted that silver is worth $173 in the real world. We have the Friday night heist, where 4.2 million ounces vanished from COMEX vaults in a single session. And we have the retail swarm, which has trapped the banks in a multi-billion ounce short position. This is not speculation. This is arithmetic. Paper claims have drifted so far from physical reality that the gap can no longer be bridged slowly. It requires a violent repricing event. As of today, Saturday, January 17th, 2026, we are staring at one of the largest pricing anomalies in financial history. Look at the numbers one last time. COMEX closed around $90. Shanghai is far higher. The US Mint is effectively at $173. The gap between the paper price and the sovereign price is over $80. That is not a spread. That is a canyon. That is a structural failure in price discovery. If you can acquire silver at $90 when the government itself values it at $173, you're not making a normal investment. You're arbitraging a broken system. You're buying something for half of what the issuer of the currency says it is worth. But these distortions never last. Markets hate imbalance the way physics hates vacuum. Reality always reasserts itself. There are only two ways this resolves. The first is that the mint is wrong, the shortage is imaginary, and the metal flows back into vaults. Prices collapse, and this entire episode becomes a strange footnote. Given everything we have analyzed, industrial demand, mine depletion, vault withdrawals, global arbitrage, this scenario borders on fantasy. The metal is gone. It is not coming back. The second path is that the paper price finally catches up to physical reality. This is the only viable outcome. The paper price is always the last to move. Physical tightness shows up first. Asian premiums confirm it. Western screens capitulate at the end. We are now in that final stage. While markets are closed this weekend, the news is spreading. Traders are doing the same math. They are realizing that $90 is not a warning sign. It is a gift. When Asian markets open and then New York follows, the scramble for positioning could overwhelm the usual suppression algorithms. If the government thinks silver is worth $173, then $95 looks cheap. $110 looks cheap. $130 looks cheap. This is how buying panics begin. So what is the verdict? The verdict is that the great repricing is already underway. Double-digit silver may still exist on screens, but in the real economy, it is already disappearing. The verdict is that the banks have lost control of physical supply, and once you lose control of inventory, you eventually lose control of price. They can manufacture paper indefinitely. They cannot manufacture atoms. And the verdict is that We are watching a historic wealth transfer from those who trust financial displays to those who trust physical reality. So what is the strategy in a market like this? First, do not sell your physical metal too early. If silver spikes to $100 or $110, it will feel euphoric. You will feel clever. You will feel rich. But remember the mint's own price. Selling at $100 when the government values silver at $173 is not profit-taking. It is a discount sale. Do not trade a scarce asset for a weakening currency until the paper price reflects the street price. Second, ignore short-term volatility. The banks are wounded, but they are not finished. They may try another smash to shake out weak hands. If you see a red candle, understand what it is. It is a paper maneuver in a physical crisis. The real battlefield is not on the chart. It is in the vaults, and the vaults are emptying. Third, watch the spread, not just the price. The most important signal in this market is the gap between paper silver and physical silver. As long as that gap exists, the bull market is alive and the squeeze is active. We are watching the slow collapse of a decades-long system built on synthetic supply. It is volatile, it is uncomfortable, it is chaotic. It is also a once-in-a-generation opportunity. The US government has already told you what it believes silver is worth. They say it is worth $173. The banks are short, the mint is closed, the vaults are draining, and the screen still says $90. At this point, the message is not subtle. Believe the side that holds the metal, not the side that prints the paper.